Hi everyone, I'm Lucas here. Today I'm going to just briefly talk about some trend right now and some trend trading and also some value investing. What is the method and how to use for myself and on my perspective. Okay, so as everyone knows, there's a so-called economic cycle. Okay, economic trend. Okay, there's a this is so-called 10 years trend, 10 years trend, all the 10 years trend. There's some recession and some downtrend over here, and over the long run, 10 years, 20 years, 30 years, there will be a short-term trend. Okay, the green color will be the short-term trend. So as you know, as we understand that this trend will the big trend will continue to go on unless there's some really serious major event that happen, like for example nuclear war, like for example alien invade the earth, something like that. Or else I think that if the population and the economy keep on growing, we will see this trend to continue to go on. Okay, so this is on the big trend. So as we know right now, we are on the late cycle of the trend, which is on the red color this side. Okay, on the red color here. Okay, so we are here. I still believe that we are still in a bear market right now, although there's a technical rebound which seems to be quite promising about getting off from this bear market right now. But okay, when I go into detail right now, okay, this is in 10 years. So this one we zoom into 10 years trend. As you can see on the green color line, okay, I redraw everything so you can have a clearer picture. Okay, this is the 10 years line. Okay, right now there's a sharp drop. There's a sharp drop on the so-called short-term trend right now. Okay, as we expect the economy this year might go down around 20 to maybe 40%. The maximum is maybe around 40%, but the share price and the index drop beyond that. Like for example, share price right now, $1 drop until 20 cents. There's a 80% of drop, but we assume that the economy only can drop around 20 to 40%, which is maybe around a drop to around 70 cents. Okay, that's why when it's oversold until 20 cents over here, there will be a strong rebound, okay, to maybe around 60 cents. So you will see a 100%, 200% this kind of return in a short-term trend. So does it mean that we are out from the bear market? Is not. Just that when the trend is going down, for example, a company, every year I use a example as a tobacco, the BAT. Okay, every year we expect the industry will be a sunset industry and down for 10%, 5 to 10%, but the share price this year suddenly dropped until like 50% or 60%. So the value came out, the value come out already. Does it mean that the company is a good company? No, just that when it's oversold more than 10%, which the share price should drop for 10%, there's an oversold and there's a fear involved. So there's a value there. Doesn't mean that this company will perform or will be profitable or will stop the downtrend. Just that the price drop below the business that's supposed to drop, and it form a value, so it rebounds. So same for the index also. We expect the economy to down for 20%, but the share price of the index down for 40%. So that's why there will be a sharp U-turn right here. So Okay, this is so-called the trend line. So as we expect right now, the virus thing and the economic thing doesn't really settle everything overnight. We expect this thing can drag for another 6 months, even for 1 year. So the economy is still considered a downtrend. So anything that rebounds to the resistance point, you must be really careful. And if touch the resistance point, it's around here, and doesn't have a momentum to go up somewhere, and which happened last week, bring forward to this week. So you need to be careful right now because you are trading on a small trend, unless you are Warren Buffett. Warren, he cannot buy at the bottom here because he need quantity. He need to start buying here. If he buy bottom here, he won't able to collect the amount that he want, because when he collect, the share price will go up. So he need to start collect here because his fund size is big. But we for us, our fund size is not big, so we can wait here until it form a higher low, which is the second wave. Then we can start to enter here big and for long term, and we can look for 100 to 500% return. For now, we are here. We only can look for short-term trading. I know that there's a lot of people gain 50 to 100% return for this technical rebound, which is a strong rebound, 100% return. But you need to be aware that current market right now is really volatile. One day can up for 10, 20, even 30%, and which one day already form last time, maybe 1 week or even 1 month kind of trend, they form within 1 day. So it's really a trading period right now. It's not an investing period. So anything that fluctuate around, you just follow the trend, short-term trend, within maybe 5 days to 2 weeks, or even up to 1 month, this kind of period. So you need to follow the trend right now. Definitely is not back to a so-called bull market right now. You need to understand this. So unless you have a strategy that is for your blue chip stock to average down, and then maybe you have your capital allocation for average down for maybe 3 portion, and that is a different kind of strategy, but I will explain it later if you are using this kind of strategy. But right now it's more on trend trading. Okay, just follow the trend. When touch resistance point, you need to zoom out the chart and see on the big chart and see where is the resistance point, where is the support point. Buy on support point, sell on resistance point, and be aware of the risk right now. So you ask me what is the direction that the share price is heading or the index is heading. I cannot give you any prediction. Any prediction right now is just a prediction. Okay, cannot be accurate. So the best way right now is to follow the trend. Okay, back to value investing. Okay, there's a 3 kind of a different type of counter right now. Okay, the first counter, I erase everything first. Okay, the first type of counter is growth counter, which is, for example, like technology counter, like those booming industry. So you get this kind of earning or this kind of growth. Second is stable counter, which is like, for example, telco, Genting Malaysia. The growth is limited, maybe around 2 to 5% a year, and they are selling at high PE. So usually you won't buy this kind of counter at normal circumstances or normal time, because their share price is always expensive. Okay, always expensive. So when do you buy this kind of shares? When the market crash. When the market crash, it discount 50%. So already down, already the value already come out. Okay, usually sell at a very high price, high PE, but now drop. So the PE, the valuation came down. So this is the chance for you to buy this kind of blue chip stocks. Who will buy this kind of stocks? Usually for those who seek for high dividend. High dividend, and their capital is big. Okay, high dividend. And their capital is big, and they don't want to take extra risk. So you can search for this kind of counter. Like for example, why now usually people don't look at Maybank or CIMB Bank, this kind of bank. Why people start to buy now? Because drop to a certain level which is a discounted price right now, so people start to buy, and then the dividend yield is very attractive right now. So this kind of counter won't give you 500% return. Maybe around 50. When it's go back to normal price, you get around 50% to 100% return. The max will be 100%, and then will be stagnant and then continue to grow very slowly. So this one is suitable for those who are seeking for retirement or seeking for passive income and have a big chunk of capital. If you are a youngster and you're looking for capital gain and increase your net worth, you go for the first one. The first one. So the first one usually will be a growth stock. 1 year growth on 30% to 50% or maybe more. Okay, but when it drop, when the bear market happen, when it drop 80%. Why? Maybe when it expand, got debt. Sorry, you got debt and cash flow very tight. Cash flow problem, and it's very risky because of small scale. So some of the company might not survive. If the company is survivor and can perform when everything is over, can perform like last time, you can see a 300% return to 500% return. This is the stock that you need to find. If you want to grow your network and you want to really enjoy all the capital gain, this is the one that you need to do, need to find. But you acquire a lot of study, and you really need to calculate all the risks. Okay, so usually I will prefer the first one. To buy, and then if you are maybe a conservative investor, you can split your capital 50 to the first one or second into blue chip stocks that give you a passive income. But if you are a youngster, you are less than 30 years old, and you have a minimum very limited capital, I will suggest you to go for the first one, because you want to grow your capital, but you need to do extra work. You need to take some risk to invest into this kind of counter. The third one will be the downtrend counter. Like just now I give you the example already. BAT, newspaper company, the Star Media, this kind of company. So they are downtrend company. So every year they down for 5%, 10%, but when bear market come, they down even more, 50, 60%, and then they rebound back. So you have a 30% upside. But if you already have a first choice and second choice, why do you need to choose for the third choice? This is just for your understanding and for your knowledge. Unless you really cannot find any good stock, then you choose this. But I don't think, seldom happen. So don't even think of this. Okay, this is just for your knowledge. What you need to do is to think of what kind of investor you are and what is your risk appetite, and how long does you want to spend on studying a stock, and how much effort you want to put in investing. If you want to put in a lot of effort in investing, I will suggest you to search for the first one, maybe software counters, technology counters, some EMS counter, which the potential growth is still there and doesn't affect or cause any permanent damage to their business in this time round. Then you can start to do into this counter. If you have a lot of capital and then you want to enjoy all the dividend, passive income, and some of the capital gain, you can try for the second one, Telco, Tenaga, maybe some REITs counter, REITs, Pavilion, Sunway, IGB REITs can give you a limited upside of capital gain, but a very decent dividend yield. Okay, this is the one that you search for, the second one. So for me personally, I will still choose the first one unless I have like for example more than 2 million, 3 million. I will consider the second one, because if bear market happen and the share price is down by maybe 50%, 70% for the second one, it looks very attractive to me, because the dividend yield maybe is already up to 10%, which means like for example Pavilion, IGB, after all the things is normalized, they are able to give back, and then they are able to earn back this kind of money, so they will give you this kind of dividend, so you can enjoy more than 10% dividend, and you can comfortably retire. 3 million, 10% a year, which is 300,000, very decent for me, and depends on your lifestyle also. So I will choose the second one if I have this kind of capital. If I don't have this kind of capital, I will choose the first one. For example, I have only 30k, I'll choose the first one, because I want to grow my 30k into 300k, 3 million. So I choose the first one. Unless you already have 3 million, then you choose the second one. Okay, the so-called stable and good dividend. So really depends on you. So my advice is, right now this is still a downtrend counter. You can do some short-term trading to gain some returns, but do more study on good counters that can give you a 300% to 500% return. For those retire one, then your job is much easier. You can choose a limited counter that you can choose right now. Do a study which one more attractive to you, and which one give you a better dividend, and which one can have the ability to earn back the money when everything is normalized. Okay, that's all for today. If you have any question, please let me know right now, or you can PM me. I will discuss a bit detail with you. This is just a theory. This is just a explanation, for a simple explanation, because I don't want to explain until very detailed and very complicated. Some of you might not be able to understand. So I think that's all for today. So right now, let me make a conclusion. There's 3 types of counter right now. Growth, which drop a lot, that involves some risk, but your return can be 300 to 500% and more. Another one, stable counter, which is normally you cannot buy because high valuation, expensive share price, but right now drop a lot, and and dividend yield is very attractive, but you need to have a high capital, and usually your return is limited. This one is for those who search for a passive income. Third one is just a theory for your understanding. Downtrend counter, but if down a lot, there's a value coming out, and then the share price will rebound and back to the price that is supposed to drop. Okay, right now, and the trend right now, still a downtrend for all the index and all, I think for most of the stocks right now. So now is for you to trade for some short term. If you don't know how to trade for short term, and then you don't want to expose to any risk, try to stay away from the stock market. Do more study right now and find a good counter, and when time is right, start to buy. Okay, and there's also different kind of strategy for averaging down strategy, and for trading strategies. So if you have any question, just let me know. Okay, I think that's all for today. Thank you very much, and have a nice day.